Good evening and welcome to Economics Unbound. Tonight we shed light on these often paradise-like domains or island countries that offer bulletproof secrecy for those who wish to make use of their very relaxed tax systems. A tax haven is generally an offshore country that offers foreign individuals and businesses little or no tax liability in a politically and economically static environment. Tax havens also share limited or no financial information, often with foreign tax authorities. Now, tax havens may not be for everyone, but economics is for everyone.
Tandega, talking about sunny places for shady people with shocking amounts of money to hide. Yes, Tandega, according to Investopedia, tax havens benefit from the capital their countries draw into the economy. Funds can flow from individuals and businesses with accounts set up at banks, financial institutions, and other investment vehicles. Individuals and corporations can potentially benefit from low or no taxes charged on income in foreign countries, where loopholes, credit, or other special tax considerations may be allowed.
Yes, Nana. Dear Nana, I will have you know that being a tax haven is often a well-chosen economic policy decision made by many countries across the world. Policy consciousness ensures that often these are well-governed jurisdictions with stable and predictable policy environments. Now, tax havens are mostly successful and well-governed economies, and being a tax haven has often brought a lot of prosperity to the people and the country. Take the African tax haven, for example, Mauritius, which is often held up as an example of economic success in Africa. Now, it is the haven of choice for Indian money and South African money too. Dear viewer, did you make a killing or an obscene amount of money in one of these 5 industries that experienced a post-COVID boom? Are you now in need of a gentle post-COVID tax dispensation?
What are those industries, Tandeka? Are you talking about grocery delivery businesses that did well throughout the world, or education or edtech businesses? During this outbreak, many have turned to online education, and edtech companies have found an opportunity here, as worldwide traditional learning and training institutions are trying to adapt and accelerate their transformation to remote teaching.
Now, in a moment of crisis like the one provoked by the coronavirus, the problem of tax avoidance, profit shifting, and tax evasion becomes particularly relevant, even more when they are blamed for cutting national resources to ride out the crisis and save millions of lives. Now, experts and activists in many countries are appealing to governments to go after offshore companies, excluding them from the benefit of national COVID-19 tax measures. Nana, let us just listen to more about this, which is brought to us courtesy of TLDR News. Thank you.
Over recent years, people have become increasingly annoyed with organisations and public figures taking advantage of tax havens. The use of tax havens allows people and companies to pay lower rates of tax than they would in their native countries. And this isn't a small issue. £5.3 trillion, or about 8% of the world's wealth, is estimated to be stored in offshore tax havens. Moody's estimates that the giant US tech companies alone kept £1.4 trillion offshore at the end of 2016. The Tax Justice Network estimates that corporate and personal tax avoidance costs the world's governments $700 billion a year in lost tax receipts. So let's go through the basics. What are tax havens? How do they work? And why is it all so controversial? So as we've already touched on, the use of tax havens is a financial technique which allows people and organisations to pay less tax. A tax haven is a term used to describe any country which offers your citizens and businesses lower rates of tax than your nation does. There are numerous tax havens across the world which have favourable tax laws allowing people to pay lower tax rates. These include famously Bermuda, the Cayman Islands, Jersey, the Bahamas, Belize, British Virgin Islands, Andorra, and many more countries. There are a number of different ways which businesses and individuals can avoid taxes using tax havens. First, let's start with corporate tax avoidance. One of the biggest ways that organisations can utilise tax havens is called corporate profit shifting. This is where a business registers their headquarters in another country which has a lower rate of corporate tax than their native country. For example, the UK corporate tax rate is 19%, so if a UK business moved its headquarters to Switzerland, they'd be able to pay the lower 8.5% tax rate instead. The difference would be even bigger if the business moved to the Cayman Islands, where there is a 0% corporate tax rate. By doing this, the company books its profits in the tax haven and only has to pay the lower tax rate instead of paying the country where the sales actually took place, allowing the company to substantially reduce its tax bill. And this isn't a rare occurrence. In 2016, nearly 2/3 of the profits made by American multinational companies were booked in 6 low or zero tax countries, these being Luxembourg, the Netherlands, Bermuda, Ireland, Singapore, and Switzerland. One technique which is very popular with big companies is to move their patents, code, formula, or algorithms to outposts in lower tax countries. This then makes their very valuable assets legally reside in the low tax country. The benefit of this is that the valuable asset then belongs to the branch of the company existing in the low tax area. So for example, a US business could move its patents to Ireland, a lower tax location, and then the patents would belong to the Irish branch of the company, at which point the Irish subsidiary could charge the US company to access the patents, making it easy to funnel profits made in the US to Ireland, just passing them off as payments for the patents. Once the money's moved into Ireland, it can then be taxed at a much lower rate, again saving a big tax bill. Individuals can do a similar thing. Becoming a resident of a country with a lower tax rate allows people to pay less income tax than they would have done previously. However, there are also other methods which allow people to live in one country while paying their taxes in another. This is done using trusts. Very simply, this allows a person to move their assets into a trust where they're managed by appointed trustees. These trustees are in charge of the trust, and they manage the assets to provide value for the beneficiaries. In this scheme, the beneficiary would be the person who placed the assets in the trust. With the trustees' permission, assets within the trust can be given to the beneficiaries at virtually any time. Very often, the trustees have very little real control over what happens to the assets. Instead, they're just paid by the person who owned the assets to put their name to the trust and appear as if they're in control of it all. Using this technique, a British person could put their car within a trust in a tax haven. They can then make themselves a beneficiary, thus giving themselves full access to the car. The individuals would still own the vehicle, and they could still use it however they wished. But because it technically belonged to the trust and was under the protection of the trustees, it'll be out of the UK government's remit, as it'll be registered to the tax haven and subject to their tax laws. This system does still result in some tax being paid. When the beneficiaries are paid, they'll still have to pay income tax on those earnings. However, the major benefit is that no capital gains tax is paid, and no tax is paid on any profit made from investing the money which is given to the trust. No matter which technique is used, a tax haven is very simply a place which charges lower taxes than your country. This attracts people and corporations to move their money to these countries to avoid paying the high tax rates in their own country. So is this a good deal for the tax haven? Why would a country even want to be a tax haven? Well, having low levels of tax allows the countries to benefit from giving itself a form of financial services industry. Often countries which become tax havens tend to have little other industry to bring in revenue. They are frequently smaller island nations whose economies don't have much industry besides tourism. Becoming a tax haven brings in vast amounts of money to the nation. Often tax havens still do have a tax rate, even though it's incredibly low. So even if a tiny percentage of the total money brought in by a nation is taxed, it's likely still more money than it previously would have earned. On top of this, there's benefits related to job and business creation, as tax havens often offer services such as trust management. There's even been talk that the UK might become a tax haven after Brexit. Leaving the EU would give the UK more flexibility to become a tax haven if it wanted to.
With the COVID-19 pandemic, tax havens have been even more immediately and strongly linked to the crisis and the prospects for economic recovery. This presents opportunities to capitalize on the renewed momentum to strengthen progressive taxation at the national level and at the international level too, to strengthen cooperation in the fight against tax havens. Other industries in which key players and shareholders have been realizing good returns and turned pandemic profits are cybersecurity, as people sought to protect corporate information from Zoom hackers and the like, or online fitness, or you may have invested, dear viewer, in some kind of safe commodity or safe currency like gold or the yen.
Thandeka, many lawyers must have made a lot of money with divorce rates and labor disputes rising. Lawyers may need to put away COVID profits. In many countries, policymakers are mulling over taxing those industries that enjoyed a COVID downfall more aggressively than those that were hard hit by the pandemic.
These are the places that facilitate, often legally, illicit flows out of countries like South Africa and other developing countries into tax havens. This is how the profit shifting happens. But the OECD has laws and prescripts and regulations to govern the operation of tax havens. The Organization for Economic Cooperation and Development, the OECD, is an intergovernmental economic organization with 37 member countries founded in 1961 to stimulate economic progress and world trade. It is a forum of countries describing themselves as committed to democracy and the market economy, providing a platform to compare policy experiences, seek answers to common problems, identify good practices, and coordinate domestic and international policies of its member countries. The OECD publishes economic reports, statistics, databases, and analyses, and forecasts on the outlook for the worldwide economy. Now we'll be back just after this short break. Stay with us, don't go away. Banks in Switzerland, Luxembourg, Austria, and Monaco have relaxed bank secrecy laws amid growing international pressure to stamp out or clamp down on tax havens. Civil society says the new reforms could help many African countries track down millions of stolen money by corrupt leaders.
Tax havens have become a nightmare for many anti-corruption lobbyists in Africa. The new banking secrecy reforms have been welcomed by many anti-money laundering activists on the continent. The relaxed banking secrecy laws will make the repatriation of stolen money from developing countries easier to track down and prosecute those involved.
We Africans have been suffering the consequences of lack of transparency in northern banks, especially the tax havens such as the Cayman Islands and Switzerland. With these reforms, it's going to be that much harder to keep stolen assets in the north.
The Organization for Economic Cooperation and Development estimates that financial institutions are holding up to $7 trillion in offshore accounts. Transparency International believes the easing of secrecy laws in international banks alone will not be effective in the fight against money laundering. It says the laws and policies need to be applied across the board and says intelligent finance units in the West need to work closely with anti-corruption leaders in affected countries.
The Swiss banks and the Swiss economy should not continue to benefit from potentially stolen money. Therefore, there should be an escrow account where this money is withdrawn from the Swiss accounts and put into. That escrow account can be African Development Bank. It can be an account of the African Union, or it can be an account of the World Bank.
Swiss authorities have already frozen bank accounts in Geneva in the ongoing investigations into the multi-billion Anglo-leasing scandal in Kenya. Up to 12 billion Kenyan shillings of the Anglo-leasing loot is reported to have been stashed in international bank accounts. G20 finance ministers promised to restrict tax havens. Amina Akram, SABC, Nairobi, Kenya.
That's a great throwback from Amina Akram. Yet the COVID-19 crisis has brought tax havens firmly back on the agenda now, as political leaders around the world have proclaimed that firms using tax havens will not be allowed to access the large-scale relief packages agreed on by governments. France, Denmark, and Poland have already taken action to bar tax haven companies from COVID-19 aid. And similar initiatives have been discussed in the US, in the UK, Canada, and elsewhere. I wonder what our policy makers are thinking. This is in part to send a political message to governments that are to people who are using state power to force businesses to de-risk their global corporate structures for tax purposes if they wish to benefit from public crisis remedies. On Zoom to chat further, we have the Associate Director, Transfer Pricing from Deloitte's Africa, Mr. Billy Ube, pardon me. Good evening, thanks for joining us. What do you advise clients to do with COVID profits?
Well, I think the issue of, I think there were two issues being discussed in the various discussions going on before while I was listening. And I think it's important to differentiate between the two. The one would be routing legitimate transactions through low tax jurisdictions to try and improve your effective tax rate. The other one is effectively hiding stolen money. So that would be money that hasn't been disclosed to the tax or regulatory authorities. It could be, for example, money that people have acquired through fraud or corruption. And that to me is not so much about tax. It's more about the fact that it's stolen funds and they're being secreted possibly in bank accounts in countries which have convenient secrecy laws. So I think those are two different issues. I think generally there is much greater transparency for legitimate businesses, for example, because of the country-by-country report, which requires multinationals to make full disclosure of where they operate, of how many people they employ in each country, of the profits they make in each country. So, revenue authorities can very quickly pick up the scenario where someone might make lots of money in a country where they have little substance. But obviously, if people are operating completely under the radar with stolen funds, and these haven't been declared, they've bypassed the conventional channels like exchange control, which is an important regulatory body in South Africa, and of course SARS, then we're talking about a rather different phenomenon, and that's really an issue around secrecy and the fact that these are the proceeds of crime.
My question really is, what is the tax morality of using a tax haven to reduce your the amount of tax that you're going to pay in the country in which you conduct business, in the country in which you live, knowing that during COVID, the country needs every single drop of revenue to ride out the storm? Is there something wrong with using money, a windfall from the tax, from the COVID period and having it and pushing it offshore? What's the tax morality in your view of that?
Well, I think it would depend on exactly what the underlying facts are. I mean, it's quite hard to set up an offshore structure in a few months. These things normally take much longer to set up. So it seems to me unlikely that someone can legitimately set up a structure in a month or two and start siphoning massive profits offshore. So I think, as I said earlier, it might be more a case of people taking stolen money offshore. When you're talking about a business and what it has offshore, and often we talk about tax havens. Tax havens are not only countries, small islands like the British Virgin Islands or Mauritius, the traditional tax havens. They can even be major economies like the UK. And the point was made during one of the comments that the UK might even become a tax haven after Brexit. So even if a country has quite a high official tax rate, there might be things like tax holidays, there might be assessed losses that people are making use of in country. So it might be that even though it looks quite respectable on the surface, there's an underlying illegitimate tax purpose going on. And really, I think one can't make general comments about the legitimacy or the morality of the structure. One has to dig a little bit more deeply and say, what is the substance of the arrangement? What is the business reason for being in a particular country and making your profits in that country? I think we can safely say that if there are no reasons other than trying to get the best possible tax rate. And if there's no substance and if there aren't any people or any assets, then that might very well be an area where tax authorities would regard it as unacceptable and civil society would regard it as immoral. But these things have to be looked at on a case-by-case basis.
Now, what do you think is in the mind of governments in Europe, like the Belgian government and France, that are saying that those companies that are highly exposed to tax havens, that have put money away in tax havens, should not be allowed to benefit from public funds and from tax breaks afforded to companies in the post-COVID recovery era?
Well, I think there's a massive focus globally on what they call base erosion and profit shifting, called BEPS, a new four-letter word. And that includes multiple different initiatives of the OECD, including the country-by-country reporting regime that I referred to earlier. So I would imagine that this would form part of that, if groups are considered to be highly aggressive in doing tax planning, if they have been found to put a big chunk of their profits in a low tax jurisdiction, governments will somehow not allow them to participate in this kind of public funding. Because in the end, I suppose the cost of the funding is borne by the taxpayer. So conceptually, it makes sense to say that if you are not an upstanding and respectable taxpayer, you should not benefit from funding derived from the taxpayer. I don't know the specifics. I mean, that obviously one would have to again look and say what are the exact criteria, at which point you will disqualify a multinational. I mean, obviously the applicant, I assume, in Belgium or a country like that would be a Belgian company. Would its association with a group that has a significant presence in tax havens, would that be the problem? So I'm not exactly sure about the specifics, but I think in principle, it does kind of make sense that if you are not seen to be an upstanding taxpayer, you shouldn't benefit from funding, which ultimately is obtained via tax collections.
Now, we were supposed to be joined by the tax commissioner, Mr. Kieswetter, and we were supposed to have this conversation, you, myself, and him, but he's had to be called away, duty calls, unfortunately for us. But what would you have advised the South African tax commissioner, if he were here, about a post-COVID tax regime for the country? How can we claw back? How can we increase the revenue collection in our country, given that we've had a few years of shortfalls?
Well, I'm a great admirer of the commissioner. I think he's an extremely articulate and clear-thinking man, and it's very clear that he sees it as his mission to rebuild the effectiveness of our revenue service. And I have to say that whether one is speaking as a South African taxpayer or an advisor like me, it's in our best interests to have the most effective SARS that we possibly can, because what we want is people paying the correct amount of tax. And it's in all of our interests that, evaders, tax evaders, or people who aren't declaring their income, or people who are being unduly tax aggressive, should be put under investigation. And there's a thing called the tax gap, which is effectively the difference between the tax that should be paid and the tax that is being paid. And for all of us, especially taxpayers, we want that tax gap to be as little as possible, because that makes it possible in the future to cut tax rates. In the end, if there's a shortfall in tax collections, it's very, very difficult to cut tax rates. Whereas if we grow the economy and we have the most effective SARS we can, I think that's the best thing we can do for all of us. I think the other key thing which South Africa does, which is also a very good thing, is that we stay close to the OECD. We're not an OECD member country, but we are early adopters of the rules, and we are active participants in the OECD discussions. We were one of the first countries to introduce country-by-country reporting, the amended transfer pricing documentation requirements, and all the other initiatives of the OECD. And that makes us part of the mainstream of the global economy. I think many African countries are not as closely linked to the OECD. They bring in their own types of tax. For example, Nigeria has just brought in a digital services tax, which is, I think, a little bit premature because there are discussions around that going on with the OECD. They might very well provoke a big backlash from the US and other investors. So while we need to focus on collecting tax revenue as effectively as possible, we also need to be at a welcoming environment for investors, because we all know the importance of investment. And in order to be that, we need to also follow best practice globally. And at this point, I firmly believe best practice is established by the OECD. So I think apart from increasing the effectiveness of our revenue service, the other key thing we need to keep doing is staying close to the OECD, contributing to the discussions happening at the OECD, and adopting the same rules as those of our major trading partners.
Would you say that we need to also develop relationships with these countries that have this kind of model, this soft tax jurisdictions? Do you think that we should have deeper relationships with them so that we can work towards more transparency and more information sharing?
Well, we are already, as I said earlier, active participants in the OECD. The OECD is the main forum where these discussions happen. So, for example, enabling the exchange of country-by-country reports globally, it's a massive process. And how that was achieved was by signing a multilateral instrument, which updated tax agreements all around the world in a flash. It would have taken years and years to renegotiate all the different double tax agreements. By working through the OECD, we were able to be part of that program, and we were able to update many of our double tax agreements. We were able to opt in and out of certain clauses. So I think, yes, by all means, we can talk to individual countries, but the most fruitful thing for us to do is to be part of the big discussion, and that happens within the OECD.
Now, I am in preparation for speaking to you. I read something that an academic had written this morning, and it stuck out for me, and I tried to mull over what it really means. Basically, he said there can be no tax justice or tax efficiency if there isn't tax justice. What do you think of that? What are your views on tax justice?
Well, tax justice, I suppose, means that people pay the correct amount of tax. I do think we have to also acknowledge, though, that most economies try and attract investment through giving tax breaks. And we as South Africa are no exception. So we, for example, give incentives in the motor industry, and that's helped us to build a very significant manufacturing industry. So I think it can't be said that any government doesn't have tax breaks. They give tax breaks for R&D. They give tax breaks for industrialization, for investment in significant manufacturing assets. Tax breaks are one of the tools used to encourage investment and to direct investment in the way that people want it to go. So I don't think one can say
how
that
should
tax
we
is
direct investment?
Well, I think post-COVID, we will be more anxious to attract investment than we ever were. We will want investment, we will want employment. I mean, employment is massively important in our country. We know the enormous unemployment rate we had before COVID started, and that's grown significantly under COVID. So if I was directing tax policy in this country, I would do everything possible to create employment. And it has to be said that employees' tax on individuals, contributes much more money than corporate income tax. Corporate income tax and all the stuff that we're talking about, up to now as being corporate income tax, is only the third biggest contributor to revenue. The first one is employees' tax. The second one is VAT. And those employees who earn the money and pay tax spend their after-tax money in our economy and pay VAT. So by growing the economy and getting people working, we are contributing to the two biggest tax collection areas. So in terms of what we do post-COVID, I would say we need to try and attract every scrap of investment we can, as opposed to trying to squeeze more money out of the existing tax base, which is already very heavily taxed. And we need to do so, in my view, with a view to creating employment. That's the single biggest thing we can do for our economy and also for our society.
On that note, Billy Hubert, thank you very much for joining us this evening. Thank you very much.
Pleasure.
Paradise Papers were taken from two firms that help companies to set up offshore operations, and they relate to no less than 19 tax havens like Bermuda, Jersey, and Mauritius. Several high-profile individuals and companies abroad have been mentioned in the Paradise Papers, that is, a while ago. And while using offshore destinations to avoid tax is usually not illegal, it raised a lot of questions about tax morality. Let's listen in to this clip and this interview that my colleague Francis Hurd did a while ago.
There is a very thin line between the two. There's a well-known quote that says the difference between tax evasion and tax avoidance is the width of a prison wall.
Yeah.
Tax avoidance is, by and large, legal in terms of the letter of the law. It really, the interesting thing about the Paradise Papers is they open up a window into this offshoring firm that specializes in helping uber-rich clients avoid tax. And these are companies and individuals. And the sort of bread and butter of this firm is structuring deals offshore, structuring offshore companies and trusts in a way to minimize tax liabilities. And it shows us that this is something, and of course we knew already, but once again it highlights just how widespread this issue is. It's everyday. It's an everyday thing. It is very much the norm for companies to be doing this, to be setting up very artificial, complicated structures to avoid paying tax in the countries where they do business. And it also, interestingly, gives us an insight into the sort of parallel moral universe that a lot of the super rich live in, where it is okay to avoid tax, where it's something that's praised. We're setting up all these complicated structures so that they can avoid tax is hailed as something innovative, and where social responsibility and tax is something that is burdensome.
If they're not doing anything illegal, do you think because of the moral reasons it is fair enough to name and shame them, basically?
Yes, and it is a cat and mouse game. You mentioned Apple there, for instance. As soon as they're exposed for avoiding tax using X tax haven, they'll switch things around and move to another tax haven. And it is unconscionable. I think there's growing consensus that this is very harmful, particularly for developing economies, particularly for Africa, that is hemorrhaging money that should be spent on infrastructure and services. And these companies are benefiting from the things that taxpayers benefit from services and infrastructure and opportunities, and are shirking the most basic social civic responsibility, paying taxes. There are two things in life that are certain, as Ben Franklin said: death and taxes.
Well, tax is not so certain, it seems. Let's look at the local companies. Shanduka, Cyril Ramaphosa is not there anymore, but he was a shareholder. How does it look for him, and what's the claim there?
Look, in this case, it's complicated. Cyril Ramaphosa and Shanduka were not, it would appear, doing anything terribly wrong, certainly not doing anything criminal, it would appear, from the information that we have before us. But it does raise eyebrows when the deputy president and potentially soon to be president of a country is doing deals in tax havens. Now, Appleby, the firm that was structuring this deal, that was working with the various entities involved in this big gas project in Mozambique, flagged a whole lot of suspicious transactions. We don't really know the full extent of it because the information, the leak in this regard is a little bit patchy. But this is not the first time that Shanduka has been implicated, that Ramaphosa has been implicated in tax avoidance. You'll remember the MTN saga, and of course you mentioned Lonmin earlier. Lonmin and Bermuda and profit shifting and transfer pricing and all that.
Is the basic claim, so if you use Mauritius to set up a company to buy an investment in Mozambique, rather than using a company in South Africa, you avoid some of the profits and some of the taxes being generated in South Africa? They're generated in Mauritius.
Yes, look, there can be legitimate reasons for investing in Mauritius, right? Say you want to set up a hotel there. But when you see these complicated tax structures, often using multiple tax havens, people can shop around because tax havens each offer individual things. And one very appealing thing about Mauritius is it has a whole lot of tax treaties with other African countries. That means that if you're a multinational company and you want to do business in Mauritius and in Mozambique, and you structure the deal through Mauritius, you can be paying an effective corporate tax of 0%. Yeah. A common thing, for instance, it would be to set up a shell company in Mauritius and be paying that company. You'd have your main operations in, say, Mozambique, a shell company in Mauritius, and that company in Mozambique will be paying, say, management fees or service fees, which are bogus because the operation in Mauritius is just a shell. There's no staff there, there's no operations there. But it's a way of transferring profits and dodging the tax man.
All right. And then Spar, they said that they did nothing wrong. They set up in the Isle of Man for an investment in Switzerland. And it's interesting what they say because one of the reasons given was that the rand is so volatile, which maybe is fair enough, is it?
That's extremely disingenuous and unhelpful. A multinational corporation invested in a country must bear some of the risk as well. If you're investing in a country, that comes with risk. And if everyone adopted that approach,
they were investing in Switzerland, yeah?
Yeah, sure, but that applies to any country you're investing in, not just South Africa. And this is a South African company, so we're talking about dodging taxes, and they're saying, well, that the rand is the problem, and so we're taking money offshore or whatever. The problem is, if you invest in a country, then you have to shoulder the responsibility that comes with that. And if all companies took this approach if everyone took this approach that tax dodging is fine, is legitimate, if we have some difference, some issue with said country, it would collapse economies. And it is doing tremendous damage to economies as is.
Is there two sides? And the reason I bring this up is I visited Costa Rica years before, I believe, Intel went in. And Costa Rica lured Intel with a lower tax rate, but then you had this huge development going on because IT professionals are being trained up, workers, you have a multinational that comes in and brings in skills. Mauritius, remember there was that race to be the gateway into Africa. They're offering people entry into Africa and doing wonders for their own country. Should we knock it?
Yeah, this is a boom for Mauritius, but it is a parasitic relationship that is Mauritius to the rest of Africa. And Mauritius is booming. We wrote an article that said, Mauritius's boom is Africa's bust. But the problem is precisely it comes at the expense of other African economies. This tiny little island of 1.3 million people may be doing fairly well, but millions and millions and millions are being sucked out of Africa every year. And I do think that is a huge problem structurally for the global economy, because it is perpetuating massive disparities in global wealth. It's perpetuating underdevelopment in Africa. It's exceedingly harmful. And a much better system, of course, would be to have proper structures in place, a sort of global consensus on this, global regulation and international law that worked in the interests of countries broadly, that worked in the interests of developing countries.
So what is that? Should there be a minimum tax rate around the world?
Perhaps that's a conversation that should be happening, yes. Yeah. But certainly all these big, these glaring loopholes need to be tightened up, and that requires a truly multilateral effort. You would think that the AU would be doing a lot more. You almost need every country
involved, and that's so difficult.
Sure, but there's a lot more that can be done on a regional level. So the AU could be doing a lot more to tighten up tax. They've flagged the issue as something very, very serious. Thabo Mbeki's high-level panel flagged it, showed that 80 million a year was being siphoned out of Africa through illicit financial flows. And it's not just about tax, because so often this coincides with criminality and illegal money. These tax havens don't just serve those who want to legally avoid tax. They also serve the interests of a whole plethora of crooks.
Apple spoke out about the idea that multinationals share their tax burden across all the geographies in which they operate. So at least it's kind of fair. But they were saying that the rules aren't clear. There's a need for simplicity. Like you say, they're one of the biggest ones named. I guess if they're saying that, it means something needs to change.
Yeah, I mean, it's risible that they can say that because they're among the biggest offenders when it comes to tax avoidance. And they have enormous cash reserves, larger than many countries, most countries perhaps, and yet they are paying pennies in tax. It's absolutely ridiculous that they can say that. They are manipulating the massive loopholes in the financial system.
Very quickly, should we as consumers start boycotting or punishing companies that dodge tax?
Certainly consumers could do a lot more. It does become difficult. You've highlighted how many companies and individuals individuals are to blame as well. But unfortunately, it hurts ordinary people the most. Those who can most afford to pay aren't paying, and those who
the little people,
if you will, pay tax.
And now we continue to expose you to the debates, both past and present, on the issue of tax havens, profit shifting, and illicit flows. Now, African countries need to strengthen their tax and custom authorities, as well as their financial institutions, to stop illicit flows of finances from the continent. This is one of the recommendations of the high-level panel which probed such outflows from our continent. Former South African President Thabo Mbeki presented this to the AU. Please listen in.
Reporting back after the panel visited 6 countries, case studies were done and talks held with heads of states, finance ministers, and financial institutions. At the heart of the problem, monies illegally earned and transferred. Resources, including minerals, are exported illegally, and countries lose out on tax revenues. The panel says African countries must have the capacity to deal with the problem.
It's necessary for our governments to strengthen, for instance, the tax authorities, customs authorities, financial intelligence units, the supervision by the central banks, Reserve Bank, of the other banks, to see what monies are moving in and out, that is this legal money, is it illegal money, in all of that.
The panel also recommended an automatic exchange of tax information among African countries. But there is a worrying factor.
These tax havens, take the Cayman Islands in the Caribbean, which is a tax haven, and people take money out and it goes there, and you don't even know who owns it. They put up fake companies and so on, so that nobody in the world is able to, they don't pay taxes. And they hide these resources there and so on. So it's a matter we've got to deal with.
Mbeki says Africa loses almost $60 billion a year in illicit financial flows, money that can be used to build schools and improve health facilities. The panel's recommendations were endorsed by the summit. Lehana Tsotitsi, SABC News, Addis Ababa, Ethiopia.
Research conducted by the South Africa Towards Inclusive Economic Development estimated that South Africa loses about 7 billion rand a year due to profit shifting by multinational corporations. This amounts to about 4% of the total current corporate income receipts. Let's listen in.
Firms, they can exploit loopholes in the current international tax laws and shift their taxable income to tax havens. And in this way, they can avoid corporate taxation altogether. Now, in this new research project, we find that the South African firms, they are engaged in this type of behavior. And it's important to understand that why this is happening is really because of some fundamental flaws in the international tax laws that, for example, allows a firm to shift their intangible assets to tax havens. Now this sounds very absurd because it is a bit absurd, right? How can you move something that isn't really present in the physical world? But that is what current tax laws allows, and that is why we're seeing this type of behavior.
What kind of companies are engaged in this behavior, and is it the majority of companies in South Africa?
So a really interesting finding is actually that the vast majority of companies in South Africa are not engaged in this type of behavior at all. It's really only the very largest firms. So what we find is that 98% of all profit shifting is being done by only 10% of the very largest firms, right? So you have a situation where most firms do not engage in this type of behavior, but a few very large firms do. And that's a problem beyond tax collection because that really distorts competition.
Mm-hmm. You said that another place where there's loss in terms of taxes, transfer mispricing on goods imports.
Yeah, so that's really one of the ways that you can shift your taxable income. That is when you're transacting internally in goods. And this is another study that has also been conducted by me, where the good news is that maybe something can be done here. Maybe using new big data analytics, the South African Revenue Authority and revenue authorities across the world might be able to recoup some of this tax loss by using these new machine learning techniques, etc.
And so how much does that mispricing cost South Africa?
That's about 1 billion rand. So it's a minority share, but it's a share that we might be able to recoup using these modern statistical techniques. So there is some hope that some of this loss can be recouped.
And so talk to us about how transfer mispricing decreased momentarily, but since has returned to its former levels.
So all the time, the OECD and South Africa is engaged in trying to implement new laws that can limit this type of behavior. And what we really saw in South Africa was that the introduction of new transfer mispricing legislation that really led to a decrease in this behavior. But then after a couple of years, firms, they found a new way to get around this, and it returned to its original level. So that's really showing that this is not an easy problem to tackle. And we can't make small solutions. We really have to think of how we can fundamentally reform the corporate tax system in a way where firms simply cannot do this anymore.
Well, a new tax dispensation is emerging in the post-COVID country, South Africa. And we'll keep you up to date with all the developments on this front from us. And that's how we say goodbye tonight.